What if carbon had a price, not only for companies, but for the entire global economy? Right now, carbon emissions are no longer invisible. They are measured, recorded, priced, and increasingly treated like money. And this shift is happening faster than most people realize. Carbon credits were originally introduced as a regulatory mechanism. One carbon credit represents 1 metric ton of carbon dioxide released into the atmosphere. In the beginning, the system focused on large emitters, factories, power plants, airlines, and heavy industry. Governments set emission limits. If companies exceeded those limits, they were required to buy carbon credits. If they reduced emissions, they could sell unused credits. This simple rule created something entirely new, a global carbon market. Over time, that market evolved. Carbon credits began to trade like financial assets. Prices fluctuated. Supply and demand emerged. Speculation followed. Today, carbon markets are worth billions of dollars globally, and they are deeply integrated into financial systems. Carbon credits now appear on balance sheets. They influence corporate valuations, capital allocation, and long-term strategy. For banks and institutional investors, carbon is no longer an environmental concern. It is financial risk. As governments introduce stricter climate policies, carbon prices rise, and rising prices change economic behavior. This is where ESG becomes critical. Environmental, social, and governance metrics are now embedded into modern finance. Investment funds, banks, and pension systems use ESG data to assess long-term stability. Companies with poor carbon performance face higher borrowing costs. Those with strong environmental metrics gain access to cheaper capital. Carbon has become a signal, a standardized data point, a variable inside financial models. But the system does not stop with corporations. In recent years, a new idea has entered the conversation: personal carbon tracking. The logic is straightforward. Every activity in transportation, energy use, food consumption produces emissions. If emissions can be calculated, they can be tracked. If they can be tracked, they can be analyzed. And if they can be analyzed, they can be optimized. Digital platforms already exist that visualize individual carbon footprints. They display trends, patterns, and comparisons, not judgments. Supporters argue this increases awareness and efficiency. They believe better data leads to better decisions. Critics raise concerns about privacy and long-term implications. They warn that tracking can slowly shift from information to enforcement. Both perspectives agree on one thing: data changes systems. Once carbon data becomes standardized, it becomes compatible with financial infrastructure. This is where technology accelerates everything. Tokenized carbon credits allow emissions data to move digitally, instantly, and globally. Blockchain-based registries reduce fraud and prevent double counting. Smart contracts can automate compliance. Artificial intelligence can optimize emissions across supply chains, cities, and entire economies. Carbon becomes programmable. This does not automatically mean control, but it does mean integration. In the same way money evolved, from cash to cards, from cards to digital wallets, carbon data is moving toward financial rails. Governments see efficiency. Corporations see cost optimization. Investors see new asset classes. Technology removes friction. The real question is not whether carbon systems will exist. They already do. The real question is how deeply they will integrate into everyday economic life. Will carbon remain a corporate metric, or will it become part of individual financial profiles? There are no simple answers. Only trade-offs: efficiency versus privacy, optimization versus autonomy. What is clear is this: finance is no longer just about money. It is about data, behavior, and systems that connect them. Carbon credits are not a distant future. They are shaping markets right now. And understanding them means understanding where global finance is heading next. The future of finance is not only digital, it is programmable,